In this video, we're going to learn how to correctly identify market direction using multiple timeframes, and how professional traders use higher timeframe analysis, because one of the biggest mistakes traders make is trying to understand the entire market from only one timeframe. They open a lower timeframe chart, see a small move happening, and immediately believe they understand the overall market direction. So if you do not understand the role of each timeframe, you will constantly feel confused. One timeframe may look bullish, while another timeframe looks bearish. One timeframe may show continuation, while another timeframe shows reversal. And this is exactly why many traders feel lost inside price action. Because they are looking at fragments of the market, instead of understanding the full narrative. And this is why timeframe alignment is one of the most important concepts in trading. Because correctly identifying market direction alone can represent almost 90% of a successful trade. A trader can have a refined entry model, good risk management, and solid execution, but if the overall directional bias is wrong, the probability of failure increases dramatically. And this is exactly why timeframe alignment is so important. Because every timeframe serves a different purpose inside market delivery. Higher timeframes are used to understand the overall direction of price. Middle timeframes help us understand how price is reacting inside that higher timeframe narrative. And lower timeframes are where we refine entries and execution. So in this video, we're going to break down how to properly use timeframes to understand market direction, instead of randomly switching between charts without context. Now let's start with the higher timeframes. The daily, weekly, and monthly charts. This is where traders identify the overall market trend and higher timeframe narrative, because higher timeframe price movement is not random. It depends on several important factors. And one of the first things traders analyze on higher timeframes is order flow. Understanding whether price is delivering bullishly or bearishly. Whether the market is forming higher highs and higher lows, or lower highs and lower lows. Because market structure tells us the current directional intention of price. If price consistently creates higher highs, respects previous lows, and continues expanding upward, that reveals bullish order flow. But if price consistently creates lower lows, fails to break previous highs, and continues delivering downward, that reveals bearish order flow. Another extremely important concept on higher timeframes is premium and discount. And this is one of the concepts many traders misunderstand completely. Because most traders focus only on direction without focusing on positioning. They see the market bullish, so they immediately look for buys. Or they see the market bearish, so they immediately look for sells. But professional traders understand something much deeper. Direction alone is not enough. Because even if the market is bullish, that does not mean buying is logical everywhere. And even if the market is bearish, that does not mean selling is logical everywhere. This is exactly why premium and discount become extremely important. Because they help traders understand where price is positioned inside the range. Which means, even during bullish order flow, buying directly inside premium often creates poor positioning. Because price may first retrace lower, rebalance inefficiencies, or seek discount before continuing higher. The same concept applies to bearish conditions. Even if the overall market remains bearish, selling directly into discount is usually not ideal positioning. Because price may first retrace upward, seek premium, collect liquidity, and then continue lower afterward. And this is one of the biggest differences between emotional trading and professional positioning. Emotional traders focus only on direction. Professional traders focus on direction and location. Because the market does not only move based on where price wants to go, but also based on where price currently is inside the range. Because sometimes, the direction can be correct, but the positioning can still be wrong. Higher timeframes also help traders understand premium and discount. Meaning whether price is currently trading at expensive prices inside a dealing range, or discounted prices. Because buying at premium, or selling at discount, often creates poor positioning relative to higher timeframe liquidity. This is why understanding equilibrium becomes extremely important. Another critical concept on higher timeframes is liquidity. Understanding where liquidity is resting and which liquidity pools are most likely to be targeted next, because price constantly seeks liquidity. And liquidity usually exists around swing highs, swing lows, equal highs, equal lows, trend lines, support, and resistance. This is why understanding the relationship between internal liquidity and external liquidity is so important. Because price often reacts from one form of liquidity before expanding toward another. Some liquidity pools may require significant displacement and momentum to be reached, while others can easily be accessed during normal market delivery. And another factor many traders underestimate is market sessions. Because different sessions create different forms of volatility and liquidity behavior. The London session, New York session, and Asian session all deliver price differently. And understanding how price behaves during each session helps traders understand when liquidity is most likely to be engineered or delivered. Now, once the higher timeframe narrative becomes clear, we move down to the middle timeframes, such as the 4-hour, 2-hour, and 1-hour charts. This is where traders begin refining higher timeframe direction and analyzing real-time market behavior. And one of the most important things traders focus on here is candle closures. Not just price touching an area, but how candles actually close around that area. Because candle closures reveal true market acceptance or rejection. And this becomes extremely important when price reaches liquidity zones, PD arrays, premium or discount areas, swing highs, or swing lows. For example, if price reaches a bullish PD array, but candles continuously reject the area with long lower wicks and weak bearish closes, that often signals rejection and supports bullish continuation. But if candles begin closing aggressively with strong bearish bodies, that may signal weakness in bullish order flow. The same concept applies in bearish conditions. Because the difference between candle bodies and wicks matters significantly. Large wicks often reveal rejection, failed continuation, or liquidity interaction, while strong candle body closes usually reveal acceptance, strength, and continuation intent. And this is why middle timeframe candle behavior becomes extremely important for confirming higher timeframe analysis. Because sometimes lower timeframe moves may appear bullish temporarily, while middle timeframe structure still remains bearish overall. And this is where many traders become trapped. They mistake temporary retracements for true reversals. And understanding this difference helps traders avoid emotional entries, false continuations, and low probability trades. Middle timeframes also help traders determine whether price is continuing to respect higher timeframe PD arrays, or beginning to violate them. And finally, we move to the lower timeframes, such as the 15-minute and the 5-minute charts. And this is where trade execution happens. Because after identifying the overall market direction on the higher timeframe and confirming the narrative on the middle timeframe, the lower timeframe becomes the execution layer of the setup. This is where traders begin looking for confirmations that align with the higher timeframe analysis, instead of entering trades emotionally or randomly. One of the most important confirmations on the lower timeframe is market structure. If the higher timeframe narrative is bullish, traders usually wait for a bullish break of structure above previous highs. And if the higher timeframe narrative is bearish, they wait for bearish structure breaks below previous lows. Because structure shifts on the lower timeframe help confirm directional continuation. Another important confirmation is liquidity sweeps. Because very often, before the market expands in the intended direction, it first takes liquidity resting above highs or below lows. This is why traders wait for liquidity to be swept first, before looking for execution opportunities, and traders also pay close attention to areas of interest. Because when price reaches an area that goes against the higher timeframe analysis, but completely fails to respect it, that weakness itself becomes confirmation. For example, if the higher timeframe remains bullish and price disrespects bearish areas of interest, that supports bullish continuation. And the opposite applies in bearish conditions. At the same time, traders look for areas of interest that align with their higher timeframe narrative. Because respected PD arrays supporting higher timeframe direction often provide high probability execution zones. And this is exactly why lower timeframe execution is so powerful. Because instead of blindly entering the market, traders begin waiting for multiple confirmations to align together. Higher timeframe direction, middle timeframe confirmation, and lower timeframe execution. And when all three align together, the probability of the setup becomes significantly stronger. So if you found this video valuable, make sure to like, subscribe, and turn on notifications for more simple and educational trading content about liquidity, ICT, and market psychology. And if you have any questions or topics you want explained next, feel free to leave them in the comments. See you in the next video.